Hello, viewers. This is Saurabh Wadhwa from Tax Accountant, and today I have picked up a topic on ETFs. So, what is this ETF, index funds, and how you can do investments into ETF, and how you can build a passive income portfolio into ETF? What would be the tax implication of ETF? I like to cover these things in a super simple concept today. So be with me for next few minutes. So think about ETF. Remember, if you go to invest into shares and you pick up a stock, one company, and then you build up your portfolio, second company, third company, fourth company, fifth company. Let's say you have 5 to 6 companies that you're building up your stock over the period of years. Now all of a sudden one company go bust, boom, gone. All that money that you invested in that, because of the liquidation, all that money is gone. Or they had serious financial problems or business problems and they could not be in the business any longer, or the share values have dropped. So your portfolio will significantly shrink in value. However, you try to diversify by having a 5 or 6 companies, 7, 8, 10 companies, but still you get a significant drop in your portfolio value. So how you can mitigate that risk, how you can diversify your things? So ETFs is a very good option where you are exposed to not 1, 2, 3, 4 company, you are exposed to 500 companies. Imagine if you go and have to invest in those shares into individual company, it will take you a long time, heavy brokerage fee, you need to keep a track of all those things. But if you invest into 500 companies together, then chances are even 1 or 2 company go completely bankrupt, you won't have any problems with that. So this is what ETFs. So think about ETF, it's a basket of investment, different things are coming together, and this is how ETFs build up. So ETFs could be for shares. If you want to buy, let's say you want to buy shares into property sectors, so all the property sectors investments will build up into property portfolio. And let's say if you want to build up investments into real estate, so all the real estate stuff will be built up into real estate. Or if you want to have commodity, I want to buy gold, silver, these days even bitcoins. If you want to buy these digital currencies ETFs, that could also be a possibility of those ETFs. So different varieties of options are there. One more thing, you can do the trading like a stock. So these are generally listed on stock exchanges, so highly liquid. You can also do the trade-off to them pretty easy. The diversification is a key thing and the liquidity is a key thing. So think about it. These two are very important concepts, diversification and liquidity. So what are the benefits? Low cost. Even you can buy ETFs with as low as $100. Just go and buy a number of units. So basically what it is, let's say S&P 500, all those 500 stock of S&P 500 will be there. If you're in Australia, ASX 200, first 200 stocks there. New Zealand top 50, those stocks would be there. So investment becomes easy and selection becomes easy. And you can start with low investments as well. Low risk because you're doing the big diversification. And again, the returns in the past, now these are the past returns, not guarantees for future, but in the past they have always returned on an average of 8 to 10% return per annum. So it's quite decent return if you look at it. Now these are just the kind of ETFs that there could be shares ETF, bonds ETF, commodity ETFs. This is what I'm trying to explain here. Now this is specifically for New Zealand, the tax portion, how ETFs and the associated tax calculations are done. So basically ETFs, you will look at, are you investing in New Zealand or are you investing in overseas? If you're doing overseas investment, then this will come under FIF regime, which is foreign investment fund regime. Now you could be in any part of the world, but the rule and basic principles remains the same. So the New Zealand context might help you in Australia too. how things we do here. So smaller investors, so we have a cap of $50,000. So if you individual 50,000, couple $100,000. So two people can have up to $100,000. It's only available to individuals, no companies, no trust, and things like that. So first 50,000 exempt, not exempt from tax purposes, but exempt from FIF reporting purposes. Again, this number has been there for last so many years since the rules have come in. Perhaps it's a time to change. Things have changed. Markets have changed. People are more wealthy now. So I personally think that 50,000 threshold is low. That should be lifted up to $100,000, $150,000. That sort of investment level. 50,000 is way too low for the threshold. And what we will do, we'll look at how much you have invested. Let's say if someone has invested $100,000, think that number, $100,000. Now that $100,000, 5% of that. I'll just show you what I mean by this. So let's say you have a value of $100,000. So one method could be FDR method. So FDR method says 5% of opening value. So if the opening value 5% of that is $5,000, right? So $5,000 is not your tax, is your taxable income. This will go in your tax return, and this is how you will pay. Now there are some complications around quick sale gain adjustments and things, peak holding method, differential rate calculations and things. But let's not get into technicalities. But as a rule of thumb, you're looking at opening value. So 100K opening value, FDR method. So one method is FDR method. Other method is comparative value method. In comparative value method, what you will do, the opening value is 100. Now the closing value is 120,000. So there is a gain of $20,000, right? It's gone up. Under comparative method, we will say that 20,000 is your taxable income. But catch is, you have an option. You can use either FDR or you can use comparative. So you can choose to use FDR method and you can cap your income, taxable income, to only $5,000. So this is how will be kept. So you don't have to. Imagine now the value is not 120. Now the value is only 95. So it's gone below $5,000. So then again, you can use comparative value method. You can say, no, I will cap my thing to zero value, which means opening 100, closing 95, which means 5 loss. So losses, we can't use it, but which means the taxable income for that year is zero. So we have done that thing. We say, no, our taxable income for the year is only $0. So you don't have to do any reporting for that year. Point to be noted here, if you have different portfolios, like using different providers, so we have to stick to the same method for all the providers. We can't pick and choose. For 1 year, next year, you can change it, but one specific year has to be a one provider. Now think about it, if these shares are not overseas investments, they're all local investments, you're investing in local platforms and locally investments, then it will be PI investments. So depending on what kind of level of income you are. So if you're high income earner, paying 39% tax a year, then you can choose PIR funds, and in the PIR funds, then PI income will be taxed at 28%. So again, you can cap your income to only 28%. So whatever choices you make for the investments, do give some consideration to the taxation rules as well. Certain risk with any investment, some sort of risk you need to be aware of. What are the risks? ETFs move with the market. So if the market right now, property market is low, such as property ETFs are also low. So it's going to be high, ETFs going to be high, property market certainly will be high. So it goes up and down in value. If you have investments in overseas, then of course foreign exchange exposure that you have as well. And if you have a too liquid, too narrow, too niche ETF, it may not be liquid enough. So you want to focus on a broader ETF so that there is a big market that you can sell over the period of time. So key takeaways I want you to learn from that today is, this is a flexible, low cost investment and you can easily diversify your risk. Various platforms you can use. I won't name those platforms. You can do your own search, but as simple as doing something on your phone, you can do the investments. For if you are a New Zealand investor, you got PII funds, or if you're investing into new overseas markets, then you got to think about FIF tax regime, that sort of stuff. Always check your tax obligation and it aligns with your overall financial portfolio strategy, that what you want to achieve from it, what's the risk appetite and things like that, how far you are from the retirement, when do you need the money. So all sort of calculations must be done with that. Now this is just a simple example of ETFs in New Zealand or globally. You can invest into Smart NZ Top 50, or you can do investment into NZ Top 10 ETFs. It's called FNN-TNZ, or you can invest into S&P NZX ETF. So these kind of top New Zealand companies, top 50 New Zealand company by market capitalization, you can do that. Or you can look into specific sectors that these are Australian ETFs, so you can look into specific sectors. You can look into fixed income, such as bonds, New Zealand bonds, government bonds. You can look into emerging markets or broad NZ equity exposure. So various options are available. So makes investments much easier, and this could be part of your portfolio. Thank you for watching this video. Thank you.